Hello everyone. The financial year FY 2023, which commenced in April, has indeed started with a thud for the bond markets. And what I mean by that is, for starters, we saw the introduction of the SDF, which is the which suggested an increase in rate away from the reverse repo rate in the April policy, and that took the shorter end of the yield curve higher by almost 40 basis points. And then to top it up, we had an off cycle rate hike in the month of May, a couple of days back, which was probably or originally scheduled for the month of June, which is when the RBI MPC officially meets. So there's been a back-to-back jhatka for the bond markets, which has meant a lot of palpitations as far as the bond yields are concerned. We've seen massive upticks across the yield curve, as high as in the range of 50 to 100 basis points, depending on which segment of the yield curve one is in. Alongside that, we also saw a hike in the CRR, or the cash reserve ratio, to the tune of 50 basis points, which is likely to remove the durable liquidity in the banking system to the tune of approximately 87,000 crores. Now that created double whammy for the bond markets, especially at the shorter end, which obviously is more vulnerable to liquidity movements. So net, we have seen the 10-year benchmark yield trading at around 7.45%. And this was at the start of the month in April, closer to 6.8%. So we've already seen almost a 65 basis jump in the yields. Look at the 1-year OIS curve. Just in May, starting off May, it was trading at about 5.2%. And right now it's close to about 6.25. Now, why am I sharing all these data points with all of you is just to give you a flavor that the official rate hike campaign, or the trajectory of series of rate hikes, has just begun, which means there is more to go. That's the narrative that we take home from the press release of the RBI policy. However, even before those rate hikes, the discounting of these rate hikes has already started percolating into the bond yields and the OIS curve, which means that the yield curve is discounting very aggressive rate hikes as indicated by the OIS levels as they stand right now. We believe that the series of rate hikes, which has just started off in March, could pretty well continue in the month of June, which is the next slated MPC meet, and then into August, so that you at least reach a pre-pandemic level repo rate of 5.15% to start with. And then, depending on the inflation trajectory, the future course of the quantum of rate hikes for the remainder of FY 2023 could play in. How much of this is discounted into the current prices? The 4.4% on repo and the 7.45 on the 10-year implies a gap, a spread of over 300 basis points. Pre-pandemic, these levels, or the spread, was just about 120 to 130 basis points, which means even if the terminal repo rate for this year would be closer to say 6%, can the 10-year hover in the band of 7.5 to 8%? The answer is probably yes. So there is excessive paranoia, no doubt, but that does not mean that yields are going to keep sliding relentlessly upwards, or for that matter, on a respite buying, go recklessly on the lower side. There is supply week on week on the government side, which may prevent abrupt fall in yields, and at the same time, given the fact that too many rate hikes already getting priced in, can mean a lackluster sideways movement with incremental yield ranges heading on the higher side. It is appropriate in this kind of a market scenario to start considering enhancing of your duration on the fixed income side. Strategies like the dynamic bond fund, strategies like the gilt and bond fund, medium term fund, which do have a potential to run durations in line with the interest rate view on the higher side, in cases like these, definitely make a case for investments. It's also imperative that when you invest, you need to keep your investment horizons in mind and not get swayed away by the volatility, which is going to be the order of the day. A combination of liquidity and rate normalization is the new world order, and it will take a while because the bond markets have not fully stabilized. In this kind of a market scenario, the category that you choose, we believe, should be invested into in a staggered manner rather than going all in at the same time. This allows you to smoothen out your expectations from the market, helps you withstand volatility much better, and could provide a gratifying experience in a rising interest rate scenario. If you want to reduce the intensity of A, volatility, and B, probably mitigate interest rate risk to the extent possible, then target date maturity funds could be the way out going forward. So it's a combination of this that you can choose from depending on your risk appetite. Bottom line, carry is looking even more attractive in fixed income compared to what it was a month or a quarter back. So for existing investors, yes, despite the mark to market, the mantra is to stay invested. And for fresh investors, consider investments in line with the duration of portfolios that you seek to. On that note, take care and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.